The way the stock market is designed is to make sure that the least amount of people come with it when it's going higher or when it's in a bull market. And that could be a bull market in stocks or bonds or precious metals or commodities. It actually doesn't matter. But the way that a bull market works is it's going to move and slip and fall and jump and twist and twirl in all the ways to make it as emotionally difficult to stay on that path during the entire time that whatever that asset is in a bull market. And then in reverse, the way that the stock market's going to work is it's going to lure you in and keep you in as long as possible and provide the most damage to your net worth and wealth in a bear market. And this is how it's designed. And that's why bear markets are so tempting to jump into. And that's why bull markets are so hard to hang on to, because everything the market is doing, its job is to. Now, I've never actually had an interview with the market, but in my 2 decades of of looking at the market and watching the market and studying and researching the market, it is literally designed to bring the least amount of people with it on the way up, and it's designed to bring the most amount of people with it on the way down. And one of the things that I found is if you can look at price charts, of course you can. If you get the value of a price chart, you can really understand how to stay in. So instead of looking at your account and being like, oh my gosh, I'm down 2%, you can just look at a price chart and go, oh yeah, there's a little blip that falls down. And it's moving the strategy to a visual strategy, to a pattern recognition strategy, is one of the many reasons why I love price charts. So I'm going to do something kind of different today, and I'll reveal that in a second. But before I do, I want to let you guys know that I have a Peak Gold training coming up this coming Tuesday that I'm super excited about. If for no other reason that the offer that I'm going to offer at the end is literally something that I've been thinking about for years how to do, and it's something I hate when other people do to me. So it's a pretty unique and fun offer that I have at the end. And the training itself is super juicy, super meaty, and provides just an incredible amount of important insights. Hey everybody, this is RC Peck, and this is my weekend podcast. In fact, this is episode 336. And I kind of find, like, with working with people for over 18 years with their money, a lot of times what they say to themselves is they want to get above the noise. They want to get above the information, the dirt, the grime, the misinformation, and just kind of have a point of view where they can really see what's coming and really know what's happening. And one of the best things one can do is look at price charts. The other thing they can do is to have a very specific and strict strategy that's based on probability and evidence and history. And it does its job to eliminate as much human bias and illusion and effect out of the person so that person's money can grow the best. So I've got something a little special today. Every month I sit down with my research members, people who are members of Fearless Wealth, and I do something called the 30-day forecast. And I love doing this live because it literally can show in minutes so many things. Why diversification is dead, why rebalancing is dead, why investing can be super straightforward if you allow it to be, why pick of the month newsletters cannot help. And it does it so beautifully and clearly that I wanted to share it with you today. So one of the big themes and beliefs out there, and I think it's a myth, is that you should be diversified across 10 asset classes, and those 10 asset classes should be rebalanced once a year. And you hear this idea of diversification everywhere, literally from everyone, from big box advisors, independent advisors, boutique advisors, discount brokers, full service brokers, pick of the month newsletters, weekend workshops, everybody. They may rail against each other, but the one thing that each one of those silos or sectors, types of companies do, they all say you should diversify. And that's why people never question it, because, well, everyone's doing it. Maybe I just need to diversify better. And they all have their unique ways of diversifying. But I think it's just a big, big pile of garbage, and it actually hurts people. And I'm going to literally show you in the next couple minutes why, real live, how it's really hurting people. So what I want to do is jump to a set of live price charts, no screen slides today. And I want to go through and show you how you can actually find the best thing to be in today. Not one of the 10 best things to be in, but literally the best thing to be in. So what we're going to do is I first want to go to all the locations, well, not all the locations in the world, but I want to look at some of the major locations in the world and try to figure out which is the best location to have our money in. Is it Germany? Is it Japan? Is it China? Is it the US? Is it international? Is it domestic? And we're going to be able to find that out very quickly. Then after that, then I want to know, okay, well, what's the best size stock to be in? Is it large? Is it jumbo? Is it mid? Or is it small? And we're going to know instantly which one it is to be. No bias, no beliefs, no interesting stories about small caps or large caps, but the real information. And then lastly, what I want to do is look at all the different types. Well, most of the different types of places you can put your money and know very quickly which one we should be looking at. Okay, so if you hear some papers ruffling, rattling, whatever, it's me because I have some notes in front of me. Okay, so the first thing I want to show you is this price chart right here. Now, all the price charts are going to look like this with one blue line and one black line. What you're looking at the screen right here is comparing the Japanese stock market with the US stock market. If the line is falling, which the line is falling on this price chart here, that means the Japanese stock market is underperforming the US stock market. So there would be no reason to ever be in the Japanese stock market right now until it clearly bottomed and turned around and started moving up against the US stock market. So if there was a competition between which is better to have your money in the US stock market or the Japanese stock market, you could just look at a price chart like this, which compares the two on a relative basis, which one is stronger relatively speaking, and you know instantly like, oh, look, if the line is falling, that means the Japanese stock market is doing worse, like it basically has been doing since, call it April of 2013, right? But if the line is rising like it did at the beginning of 2015 for about 3 or 4 months, then the Japanese stock market is doing better. Now, we don't have time to get into all the reasons and all the ways why you can, or how you can eliminate getting in, getting out, getting in, getting out. I simply want to show you price chatters. I want to show you chart patterns, and it's for you to clearly see how having this information can eliminate a lot of the noise in your life. So if the line is falling in this case, the Japanese stock market is underperforming the US stock market, and it is in this case. So next, what I want to do, let's go to the other side of the world, and here we're looking at the German stock market. Now, again, if the line is falling, that means the German stock market is doing worse than the US stock market, and in fact it is. Then we say, well, what if it's not just Germany? Let's look at all of Europe. So here's looking at all of Europe, which of course looks very similar to just Germany because Germany is the largest economy in Europe. But here you have looking at the Euro bloc and comparing it against the United States. And as you can see, the line is falling, which means it's underperforming the US stock market. Then you might say, well, I've been told to be in emerging markets. Well, here's emerging markets being compared to the S&P 500. It's been falling for 3.5 years. Now look, down here, emerging markets is starting to move higher. Remember, when the line moves higher, it's the location of the world I'm comparing to against the S&P. So in this case, I'm comparing emerging markets to the S&P 500, and it's been falling for 3.5 years because the black line has been falling. Now, emerging markets is starting to do better than the S&P. If you look here, the black line is starting to move higher. But we don't know yet if it's a final bottom because it has to break above this. But we know that, all things being equal, the US stock market at least is doing equal, because if you start from December of last year, it's sideways. So at least it's equal. And we do know that the US stock market has much less volatility than emerging markets. So if something's equal and one's more volatile than not, you stay with the one that's less volatile until the one that's more volatile can prove itself to you. And then you might say, well, if we maybe we should just look at China here. So here's the price chart of China being compared to the S&P 500. Again, if the black line's falling, that means China is underperforming the US. If the line is rising, that means the Chinese stock market is rising faster or performing better than the US stock market. So we had some of that in kind of 2014 to 2015. I guess you don't say 2014, so 2014 to 2015. But then in May of 2015, it fell. And when we zoom and really look at this big picture here, for 3.5 years, The highs are been getting lower, generally speaking, and the lows have been getting lower. And same thing with emerging market. At best, you could say that China's doing about equal because the line's kind of just going back and forth with the US. But really, when you look at this, this is a big downtrend. And in order for me to say to someone that they should put their money in the Chinese stock market, I've got to clearly see that this line is definitely outperforming the US stock market. And then you could say, well, RC, just show me all international. So here's international right here. Clearly, if you put your money in international mutual fund or an international ETF, it's been making you poorer and it's been making your future less secure over the last 3.5 years. So here we've looked at Europe, Germany, Japan, China, emerging markets. We've looked international. And then lastly, what I want to do is just look at the whole world against the US. So comparing the whole world, that includes the US stock market. But even comparing the whole world against the US stock market, the best we could come out of this is saying, hey, it's just been going sideways here for 2016. But if you look at the last 3 years behind it, there's been a huge downtrend with possibly a bottoming. So as far as location goes in the world today, the US is still the best location to be. Maybe in the near future, emerging markets are starting possibly to outperform, and possibly the world market will outperform the S&P 500. But as of right now, it's a no. So the best place in the world right now still is the S&P 500. We cut through all noise, all bias, all illusions, all effects we do put on ourselves, all blogs, all pick of the month newsletters, and we know within about 6 or 7 price charts that right now for the location on the planet, the S&P 500 is the place to be. So the next thing what I want to do is just look at, okay, we now know location is the US. Now what I want to know is what's the best size to be in? Is it mega stocks? This is the Dow Jones 30 of the biggest stocks in the US being compared to the S&P 500. So as you can see, if the line is falling, that means the Dow Jones is doing worse. And if the line is rising, that means it's doing better. So here, the line's been rising since August of last year, which is pretty consistent. That's been 10 months of it moving higher. So for 10 months, the Dow Jones, those 30 large companies, have been outperforming the S&P 500. So far what we know is the large ones are doing better than the S&P, or let's call them the jumbo ones. The jumbo size ones are doing better than the S&P. Okay, so that's one thing we need to know. Now let's look at mid-cap. So are mid-cap doing better? Yeah, mid-cap are doing better, but not as long. Since January of this year, mid-cap have been outperforming the S&P 500. So those are definitely smaller stocks. So we know the mega ones are outperforming, the small ones are outperforming, or I say the mid-size ones. And then lastly, let's just look at the really small ones, the small cap ones. And the small cap ones have been outperforming the S&P 500 too. So now what we have is, okay, we've got the S&P 500, but which is the best? Is it mega, is it mid, or is it small? So the next thing what I'm going to do is I'm just going to compare the mid-cap size ones with the mega. So if you look at the screen now, if the line is going higher, mid-cap are doing better than mega. If the line is falling, mega stocks, the biggest of the biggest, are doing better than the mid-cap. Now what I see on this screen is generally just kind of an up and down, up and down, up and down. But look, mid-cap is doing better than the megas because you can see with this line going higher, let's call it 5 or 6 months, it's been outperforming the mega cap stocks. But it may be in a channel, but it's at the bottom and moving higher. So mid-cap are doing better than mega, and they're doing better than large. Okay, then what I want to do, so now we know mid-cap is doing better. Now let's compare mid-cap against small cap. And here we have mid-cap being compared against small cap. So if the line is going up, like right here or right here, that means mid-cap is outperforming small cap. And we just learned that mid-cap is doing better than mega cap. We know mid-cap is doing better than large cap, and we just learned that mid-cap is doing better than small cap. So this is what we have right now. The best stock market from a location point of view is the United States. Call that the S&P 500. And then we drill into the size and we go, okay, but mid-cap, the mid-cap size in the US is doing best. Pretty cool so far, right? I mean, we're doing this literally in minutes or seconds. Now, the last thing we want to do is compare mid-cap with all the different sectors, because should we be in a different type of stock? Should we be in consumer or staples or energy or utilities? And so what we want to do is compare those. And I'm going to first compare it with dividend producing stocks. So again, if you look at the screen here, if the black line is falling, and this blue line is the 70-day exponential moving average, it gives us an idea to kind of eliminate a lot of noise, and is the black line above or below the 70-day moving average. But here we have comparing mid-cap with dividend-producing stocks. And for a while, they were kind of trading places back and forth. And then, man, look at this. Mid-cap just collapsed against dividend-producing stocks. And then lately, they came back up, but they're going sideways. So I would probably say that mid-cap and dividend-producing stocks are kind of equal right now, because this is really back and forth. Yes, mid-cap took a huge hit against dividend-producing stocks, but they've kind of stabilized out. But look, everything being equal and how uncertain everything is in the world right now, I'm going to go with a dividend-producing stock over a mid-cap stock, because if the market's going to fall, we know from history those large dividend-producing stocks are going to fall less. Okay, so next let's compare. What are we going to compare? Let's compare energy companies. Oops. Keep your eyes closed. I mistyped something. So now this is comparing energy companies against mid-cap. If the line is falling, energy is underperforming mid-cap stocks. And if the line is rising, energy is outperforming. So by looking at this right now, we know that energy is outperforming. I'm going to make a little note over here. Energy so far is winning, and SDY, both SDY and energy are outperforming all the location and all the size, because we can see right here that energy has moved higher. Now, it's only been 6 months-ish, and you can see that energy greatly underperformed mid-cap, but it possibly has bottomed, and it's consolidating above the moving average line. So energy is definitely doing better than mid-cap. Okay, let's keep going here. Let's look at, this is utilities. If the line is going higher, utilities are doing better than mid-cap. If they're falling, utilities are doing worse. And utilities, definitely they've been trading places back and forth here, down, up, down, up. Again, when it falls, utilities are underperforming mid-cap. When it goes higher, utilities are outperforming. And what I see here is a lot of back and forth, the baton getting handed back and forth and just the sideways. But look, utilities has, since July of last year, let's call that a year, have been moving higher than mid-caps in these very uncertain looking fits and starts. But generally speaking, when we zoom out and kind of say, like, yeah, look, the 70-day exponential moving average is slowly moving higher. There are big consolidations, but XLU is doing better than mid-cap. Okay, then we look at XLP, which is consumer staples. Consumer staples are doing better. It looks very similar to XLU. But look, staples really have been outperforming mid-cap for much longer. They've had a big correction here. So lately they're underperforming mid-cap. But I like the idea that they've been in this uptrend for longer. So I'm going to give the hat tip to consumer staples right now. Okay, and then let's go with, this is financial. Is this financial? No, this is discretionary. Sorry. I'm like, this doesn't look like it. This is consumer discretionary, things you don't need to buy. Really outperforming mid-cap for probably 18 months, but has taken a huge hit. So clearly discretionary is off the table. And then we go, we go XL, we do finance. We see how finance is doing, and finance is doing horrible against mid-cap, so we can just skip that. We look at materials here, materials being compared against mid-cap. Again, if the line is falling, materials are underperforming mid-cap. If the line is rising, materials are outperforming mid-cap. And as a review, we learned from our location and our size that mid-cap was outperforming everything in size, and mid-cap outperformed everything in location. So, but here we have materials that is outperforming mid-cap. Okay, a couple more, and stick with me here. Let's just do 2 more. This is healthcare. Let's see how healthcare is being compared against mid-cap. Man, for a while, healthcare was just killing mid-cap, because remember, if the line is going higher, that means the healthcare sector is greatly outperforming on a relative basis the mid-cap sector. But since 2016, this huge spike up, healthcare has been underperforming mid-cap, so we can definitely skip healthcare. And let's look at telecom. Here's telecom right here. Telecom was underperforming mid-cap, but has been outperforming mid-cap here since August of last year. So we have yet another sector that's outperforming mid-cap. And then lastly, let's just for fun put in BND, which is the total bond market index, and look at this. So if you look at the screen here, if the black line is falling, that means the bond market index, BND, total bond market index, is underperforming. So it's been underperforming the mid-caps since, ending in July of last year. But since July, things have definitely changed direction. Now, they moved up for about 9 months, and then they've moved back. So right now, bonds are not outperforming mid-cap. But we have a handful that are. We have energy, utilities, consumer staples, and materials, and telecom. We have 5 sectors that are outperforming. Now, I mentioned one of them before, which was SDY, which is dividend producing. So what I want to know is energy outperforming safe dividend producing stocks? And energy is slightly outperforming here. It is moving up. Now, we don't know if it's broken out, though it is consolidating above the line. So we see energy is doing well. So let's go to the next one. And the next one is XLU. XLU is utilities. It's a really back and forth. And this kind of makes sense because utilities and dividend producing stocks, first of all, they're usually the same. But I just see a lot of back and forth, and it's just really jumbled in here. I don't see a clear sign. So I say utilities are out being compared to SDY. And then let's look at consumer staples, which probably should have more confusion. Yeah. Consumer staples, a lot of confusion. I mean, yes, consumer staples are underperforming dividend producing stocks, but it's just a lot of jumble here. And considering that consumer staple stocks are probably more volatile than large cap dividend producing, though they're very similar, we'll probably have to skip those consumer staples because they're not performing good enough to justify putting money in a small sector like that. Here we have materials. Materials right here, clearly outperforming, greatly underperforming large cap dividend producing. But then since about February, they've been outperforming. So we've got energy and we have materials, which makes sense because those two are very, very similar. And then check this out here. This is telecom. How's telecom doing? I would say telecom is a skip, or you might say, hey, you know what? Telecom pays a higher dividend, and it really looks like it's going sideways here. I could see a justification of having telecom. But again, all things being equal, it's still trending down. I mean, look at the blue 70-day exponential moving average. It is trending down still. So through all that work, though, it's really not that much work. What we learned is energy and materials, which are both very commodity-based companies. We've known, literally it took us just a couple minutes. We know, okay, look, dividend-producing stocks are doing really well. If you're going to venture out of them, you may want to look at materials or you may want to look at energy. And both of them are outperforming SDY or the dividend-producing stocks this year. But it's not like they're crushing them, right? I mean, if you look at XLE again, energy, and you compare it to dividend-producing, it's not like it's totally crushing it. I mean, to me, it looks like maybe it has bottomed and is moving higher, but it is for sure not crushing it. And the same thing with the material sector, comparing it against dividend producers. This has definitely had to move up. But man, look how many times it's moved up. How many times it's moved up, fallen, moved up, fallen, moved up. So, you know, you don't lose much if you wait and say, let's see materials break a little bit higher before you put your money in. Now, here's the thing, guys. The reason I wanted to do this was, and pull the curtain back a little bit on how I think is, you don't need to have your money in 10 sectors. You don't need to have it in emerging markets and international and Europe and small cap and mid cap and large cap and mega cap. I showed you through location, the US is the best location. I showed you through size that the mid cap is the best size. And I showed you through type, the best types are dividend producing stocks, energy, and materials, those 3 sectors, right? You don't necessarily have to go into materials and energy. but it's starting to show you, hey, I don't need to follow this idea of being in 20 different sectors or companies. I just need to know, relatively speaking, what is doing best. And in this little exercise, we learn that large cap dividend producing stocks, which is a type of stock, is doing really well and holding up against almost everything except those commodity sections, energy and materials. And if we put up precious metal mining shares, we'd see the same thing. We'd probably see that precious metal mining shares are doing great against those large cap dividend producing stocks. Again, if you see the line falling here, that means precious metal mining stocks are underperforming large cap dividend producing stocks. But as you can see here, there was a huge battle between the two. And then finally, precious metal stocks started moving up. So the takeaway is commodity-like stocks are doing well and have been doing well this year. For the previous 3 years, they've been hurting people. You don't want to be diversified just for diversified's sake. I hope you enjoyed kind of me pulling this curtain back to just give you the idea how you don't have to have stock diversification or ETF diversification or mutual fund diversification or even asset diversification where you have bonds. Just because you have bonds, you should have bonds because they're outperforming. You shouldn't have bonds because of the year you were born. So here's the takeaway. Stock diversification really only helps big box advisors and independent advisors and boutique advisors. It really only helps pick of the month newsletters and brokerages, whether they're discount brokerages or full service brokerages. They want you to trade. And these companies, when you add all of them up, including insurance companies, they really add up to the industrial investment complex. It's not helping you. It's not helping you. One of the things my clients love is that 30-day forecast where we look in a very short period of time what exactly is doing best. And I round it up at the end, not round it, but I bring it back to what is doing best. And we just learned literally in a short few minutes that it's energy, materials, precious metals, which all of those are commodity-based companies, are doing better than dividend-producing stocks. But other than those commodity-based companies, dividend-producing stocks is kicking butt right now and has been. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, I want to let you know that Peak Gold has actually started. Not Peak Gold, my training webinar that I'm putting on, but the idea that Peak Gold, that we will not have enough gold at this price. And we are in actually the third cycle of peak gold. The first one happened in the 30s, the second one happened in the 70s, and we've been in the third cycle of it, or the third turning of it, since 2000. We've just come out of a great kind of cyclical bear market, and we're moving back into it. There are so many pieces of misinformation out there. Pick of the month newsletters cannot help you because they'll never tell you to stop using their service because they're selling pick of the month gold ticker symbols. So I put together a training that I actually call Peak Gold, and I'll show you why Peak Gold, the idea of Peak Gold, has started and how it can absolutely repair and bring back control over your future and your portfolio. And that's coming up on Tuesday, so you may see some emails in your inbox for that. I definitely suggest you check it out. I don't know what part of it you're going to like best, just how clear the data and the information is, and just how heavy on the proof side it is, or just how you immediately get what you need to do and how maybe the complexity that you've bought into is actually hurting you. But, whichever one it is, you're going to almost notice it immediately. Thanks so much, guys, for being in my world. And if you do have questions about how to get onto Peak Gold or get part of that service, you can just call Patty or you can just email her. You guys have a great weekend, and I'll speak to you soon.